When most people think of property and casualty insurance, also known as personal lines, they're usually referring to either homeowners, auto insurance, umbrella insurance, and sometimes earthquake or flood insurance. Many people will purchase insurance policies based upon the fact that they are mandated to have it. If you have a car, you need to have car insurance. If you have a home, you need to have homeowners. But oftentimes people aren't looking at what does that coverage actually cover them for. They purchase either state minimums or off-the-rack coverage that is offered to them by a particular insurance company.
So you don't want to find yourself in the position of one of our clients who was driving along the freeway early one morning and found himself between two cars, one of which stopped in front of him so that he hit that car. And what it turned out to be was an attempt to collect damages from him as a result of a rear-end collision. And yet when he went and looked at his insurance coverage, he had the minimum state requirement for his automobile in terms of liability, which means his personal assets, his family home, potentially his future income were all on the line as a result of this accident. And that can be easily covered with pennies on the dollar. The larger amount of liability that you actually take out, the less the cost of the liability. The most costly part of insurance in this case is deductible, and that's why you want to measure the deductible in terms of what you can afford to pay rather than what you'd like to pay. And the flip side, the liability should be determined based upon what you might possibly lose rather than what you're required to have.
$500, $1,000 is a reasonable deductible to have on a vehicle. When it comes to homeowners, that's a little bit more up in the air, although typically you don't want to have anything less than $1,000, and for a lot of folks that deductible is $2,000, $2,500, if not higher. When you have it lower than that, the premiums can be very expensive, and again, you're not insuring against $1,000 loss on your home. You're insuring against something typically that happens if it's $5, $10, $15, $20,000. Insurance is for low probability but high impact events, so you should adjust your deductibles to be in line with the reason why you have it in the first place. And oftentimes, policies have a very low limit on either uninsured or underinsured motorist coverage, but you usually, as a rule of thumb, want to match that with the overall bodily injury coverage that you have. Some other coverage that people oftentimes have too little, or if at all, is umbrella liability coverage. And that serves, as the name might imply, as an umbrella covering your homeowners and your auto. There's a few other esoteric items that it does cover, but those would be the two main ones. And essentially that would come into play for during a catastrophic loss if someone were to get severely injured on your property, or if you were at fault in an auto accident and the damages that someone sued you for were above and beyond the underlying limits of your policy. Our rule of thumb is to carry enough coverage to cover your net worth. If you want to be more conservative, a lot of folks will go above their net worth, as in a lawsuit they can attach a claim to your wages, which of course would be above and beyond what your net worth would be. One major coverage that is often overlooked is sewer and drain coverage on a homeowner's policy. These can be fairly costly claims. This can happen either if there's a backup in a pipe, or perhaps there's a clogged drain and then your house becomes flooded. Typically the policy will not cover that unless it's specifically listed. Now, the premium to add a rider to a policy, if your homeowner's policy does not include that on the base policy, might be somewhat expensive, but again, it is a fairly common claim. If you have expensive items within your house, it could be jewelry, it could be instruments, it could be artwork or other personal items that are of value. It's a good idea to purchase a rider that specifically itemizes those high value items so that they are covered independently of the policy themselves. What happens is if you just have a policy that covers valuables, it's very generic. It will cover actual cash value, they'll depreciate it, and usually they'll lowball you in the event that you have a claim. If you go and get appraisals and you itemize those high value objects that you have specifically, you're much more likely to get the full value of what they're worth at the time of the loss. Another rider is what's called an out-servant rider. And essentially what that covers is that if you have contractors, it could be the person that mows the lawn every month, or if you have someone that does general maintenance once in a while, and if they don't cover their own insurance, they become hurt on your property, you're liable to not only get sued, and that can come into the liability and the umbrella insurance, but also workers' compensation. So if you have people that you think might not have insurance or that don't have it, that's a coverage that can save you a lot of headache and a substantial amount of money.